Hi, this is Dave DiMarcantonio, and welcome to this hopefully fairly short video on the 2 and 5 EMA crossover strategy. So the context of this video is that we had a Burlington system meetup the other day, and we had a nice gentleman by the name of Sam Kumar do a presentation on the 2 and 5 EMA crossover strategy, and it created a bit of a stir. It created a little bit of a debate within the group on the validity of the strategy. So what I'd like to do is, now Sam backtested his strategy using a spreadsheet and doing it manually and just recording the trades visually and recording them into a spreadsheet. So what we've decided to do is just try to take that strategy definition and program it into a program. I use Amibroker, and the reason why I use it is it's a very good system trading development backtesting sort of system for just for these purposes. Now this is a fairly straightforward strategy. Let's take a look. I'm going to show you the actual code. I've got a screen set up for it. The actual code for it is, it's actually easier to program the code sometimes than to actually find the ones that you program. So here it is, EMA crossover system. Now what I'm going to do, I'm just going to take you through the logic of the system itself. So here's the actual code that was set up. It's a simple crossover, moving average crossover strategy using the 2 and 5 EMA. So essentially what we do is in the first block, in the first section, we set up some parameters for position sizing. And we do that simply because we want to be able to change the number of positions and the actual starting equity in the trading system, because we're going to test it against not only individual ticker symbols, we're going to test it against a portfolio of instruments. And the reason why we do that is because we want to test for the robustness of a trading system. So for example, if it only works, if trading rules only work against or on one trading instrument or symbol, there is a good chance that, you know, all the stars have aligned and you've just found the perfect data set for that set of rules. So in order to test for robustness, we want to test it against a number of different data sets or instruments or symbols to see if it has a positive expectancy and an edge in a number of different market conditions and on a number of different symbols. So that's why we've done that. Sam pointed out to me in an email exchange that we were getting fractional shares in the trade list, and I didn't realize that. Thanks for pointing that out, Sam. So what I've done is I've set the round lot size to 1 so that you can't buy or sell less than 1 share. So what we've done is we've set up our fast moving average as a parameter and our slow moving average as a parameter. And our moving averages themselves we've defined as EMAs based on the closing price. And the fast moving average will use whatever parameter we've put in here, and the slow moving average will use whatever parameter we put in here. So in this case, we're using a 2 and a 5 as a default, and we can change those you know, at runtime in the program. So now we've got our simple buy and sell rules are just a cross of the moving averages, and we've got some extra lines of code in here to take out extraneous symbols. This is just something native to Amibroker that that's recommended you do. And then in terms of our plots, we're plotting our moving averages. So that's the last 2 lines of code. So as you can see, it's you know, it's a very simple, straightforward in terms of Amibroker, very straight, simple, forward system. So let's take a look at what the user interface looks like in the chart I've set up. Before we do that, I just need to, I'm going to set up an analysis tab so that I can move this to the side. So going back to the chart, so what you see on the chart here, on the top pane you've got candles, open, high, low, close candles. This is all based on daily data. This is the only data I have. I can amalgamate monthly data, but it's easier just to use daily data for the purposes of what we're trying to do here. So the white moving average is the 2-period EMA, and the cyan or bluish aqua blue line is the 5-period. And you can see in this pane below, it's the same setup but without the candles there. So what we're going to see is we're going to see little buy and sell candles, red and blue candles above and below where the actual signals take place. Okay, you might notice a little bit of jumping in the video. I'm actually recording it in segments because the first time I tried to record it, it crashed and it was very frustrating. So I'll be pausing the video or stopping it from time to time and then just adding the sections together. So let's just take a look. So we're going to start off with the SPY. And if we look at the analysis, let's look at the logic behind how we're setting up the trade. So in order to do that, let's look at the backtester settings. So we've got initial equity of 100,000. Now our code is going to override some of these amounts. Minimum share should be set to 1. And what we're going to do is when we first start out, we're not going to use any commissions because we just want to get an idea if the system has an edge, if if it's going to make money or lose money according to the rules that we set out. So in discussions with Sam, he talked about, he's buying on the open of the next bar. So what we're going to do is we're going to set the, instead of setting it, I usually use the close of the current bar, but we're going to use the trade next bar on open and the stops will exit on the next bar. Okay, and the stops will do the same thing. Trade next bar on open, the stops will exit on the next bar. We don't have to be too concerned about any of these other settings. This is essentially set up. The only other things we're going to change from time to time is we're going to come back in and add commissions back in. So let's take a look at what that might look at. We've got our parameters. I guess I've got it default for 10 positions in 100,000 in equity, starting equity. So what I'm going to do, let's start out. We're going to use the SPY as sort of a baseline because it's a good index of the the strongest 500 companies in the United States, or basically they're global companies, so in the world. So let's start out with 100,000 equity. We're going to take one trade at a time. And let me just make sure those settings held. Okay, they did. So our fast moving average is a 2, slow moving average is the 5. So let's go ahead and we're going to set our filters. We're going to apply it to the current symbol. So it's going to use the SPY. And we're just going to use all available data that we have. So don't worry about what the dates say here. It's going to use all the quotes that we have in our database. So I'm going to run a backtest. You can see the backtest is very fast. And I'm going to sort it by date. Okay, so when I sort it by date, the most recent trades, it's showing trades in 2017, 2016. Let's take a look at what some of these symbols would look like. Now I'm gonna cherry pick some of these trades. I'm gonna look for some profitable trades so you can see what a profitable trade looks like. And I'm going to take some losing trades and we'll see what a losing trade looks like. Okay, that was just another breakpoint in the video creation process. So let's take a look at this one here. This happened on the 2016. So let's just show the current arrows for that trade, and it'll show up on the chart. You can see that here we had a moving average crossover, and the crossover actually happened on this bar. But according to the rules of the system, it's going to buy on the open of the next bar. So you can see underneath here and on the initial pane or the primary pane, you can see where the buy signal was. And let me just grab a pen so that I can highlight that a little bit better. Let me grab a green pen because we have a green trade here. So you can see here, this is where the buy was. And then you can see here we had a moving average crossover here. It would have happened actually on this bar. And then you can see that the trade was actually, the exiting trade would have been initiated on the open price of the next bar. So this is, this is what a winning trade typically looks like. And we use this as a visual to see if our rules are actually following what we've set out, for the trade rules, just to do a visual check. So now let's take a look at what a losing trade might look like. And let's see, we'll find one that's a definite loser. So this one lost 3% in 2016. We'll show that those current trade arrows on the chart. And you can see here, this was the trade. So if I just grab my handy dandy pen here, I should choose red because it's a losing trade. So you can see here, this is where the trade was initiated. We're doing long side only trades, by the way. So you can see there was a moving average crossover, the 2 above the 5 here. And it happened actually on this bar, but we're going to buy on the open of the next bar. So that's where that's taking place. Then you can see here, we didn't actually have a moving average crossover yet here, but when we gapped down, that created the moving average crossover and initiated the signal. And then according to the rules, we're going to sell. We're going to close out our position on the open of the next bar. So that's what a losing trade might look like. Okay. Okay, so if we go back to the actual analysis then, after, now that we know what a winning trade might look like, an example of a losing trade, let's actually take a look at what the statistics are telling us. So automatically, okay, so I had a crash situation there, so the continuity of the video might seem a little bit broken up. So let me just jump back to where we were. I believe we were testing. We're going to look at the statistics of the back test just based on the SPY. So for some reason, Amibroker and my video recording software don't play well together. So let's just make sure we have the same settings as we outlined before. This is going to be overridden by our program. Trade next bar at open, stops exit next bar at open, etc. I think we're good to go. No commissions are in there. We're going to trade one position, $100,000 per position using the 2 and 5 EMAs. And let's just run the back test again on that symbol. It's going to use all the quotes that we have in the history. And if I look at the statistical report that is generated, so what it's telling me is that it started out with $100,000 and it ended out with almost $72,000. So you can see here the average trade profit loss is going to show a negative expectancy. So what this does is it looks at the an expectancy calculation based on profit of winners plus profit of losers. Okay, so and then it'll tell you the expectancy dollars and the expectancy percentage. So you can see here we had winners were almost 40%, losers were about 60%. And if you look at some of the other key statistics, you did have a positive payoff ratio of 1.56. Make sure I'm looking at the right line. Sometimes it's hard to see it. Oh, I'm sorry. You actually had a negative value for a payout ratio less than 1. So you can see it's overall negative. If you look at the actual equity chart, you can see there were periods of time where it actually performed quite well in the SPY, and then you have areas of drawdown, areas of performance, and then you have areas of drawdown, and then it's just basically flat. So some of the key things to look at here to be aware of if you don't have enough data or enough experience looking at these things is you can see the maximum drawdown that this system encountered at one point in time was 60%. So that would have been a 60% drawdown of your account. Now, if I just go back, that'll show out in the statistics over here where it says the maximum system percentage drawdown, 65%. So that's a pretty significant drawdown. Now, if you look at the profitability, you can see in 1993, starting in 1993, going all the way up to 2016, and the beginning of 2017, you can see here it had, some flat to down years. It had some quite profitable years. There were some years on the SPY where it worked. This year it worked. It was 16% up, compounded annual return, 5% up. And then you can see you go through the years 2000, 2001, 2002, 2003, which I believe were, were hard years in the market with the tech bubble, and you can see that they experienced pretty significant losses. You can see in 2008, as expected, it experienced a significant loss, and 2012 experienced a loss. And the last 3 years haven't worked, or the last 2 years haven't worked too well. This is just for the SPY now, so let's keep that in context. And 2013 had a really good year. Okay. So if you take this in context and you look at, if you're looking at a period, let's say you started your backtesting in 95, you would think this is a fantastic strategy, and you wouldn't understand necessarily what could happen over a large set of data and over a number of years. So you can see overall, based on the start and end dates that we have in the system, it's showing on the SPY that it doesn't have any sort of type of positive expectancy. Now, that's not to say it's not a valid, potentially valid strategy. So what we're going to do, we're going to use the same process, and we're going to look at some individual symbols, and then we're going to look at a portfolio of symbols. Okay, so here's some of the symbols that I know Sam was trading. We've got TNA. So here's the TNA chart. Let's run the same analysis on the TNA chart. We're going to look at the current symbol. We're going to look at all quotes, so these dates don't matter. But instead, I know Sam, I think, was looking at using $5,000 and trading one position at a time. So let's see what that looks like. And let's go backtest. And we can see, we can show a couple of examples. Let's show a profitable example. This is a great one. It did 40% on this trade. And let's show what that looked like on the chart. So you can see it got in around this point here, and it got out around that point there. This is a picture-perfect example and trade that you would want to see. This was back in 08/11, 2016. Okay, so let's take a look at what a let's see here. Now this will be an open. I believe this is an open trade. I'm not sure if it's stopped out yet. The most current trades can typically be open trades. So let's take a look at what this one looked like. No, this would have been stopped out. So this was initiated just on the 25th of January of this year. There was a buy signal here. You can see the market's pretty sideways in TNN at this point. There's a buy signal here on the 25th and a sell signal here on the 31st of January. So you can see where that played out. Now let's take a look at what the statistics tell us. So I'm going to run a report. And if we have a look at what the report looks like, just based on the money management rules we have, you started out with $5,000 and you're down a little bit. You're at $4,500 as of today. You have a win rate of 37.44%. You have a losing rate of 62.56%. And if you look at the charts, you can see it's it's very up and down. Let me just jump back and look at what the maximum system drawdown was almost 70% over the data of this period. Now, I think now is a good time to segue into this discussion, because my data was a little bit different than Sam's data. So I sent an email to support for my data vendor, and this was, you can grab a screen capture of this, you can have a look at it and do a little bit more research. But basically what Ted from Premium Data was telling me was that the price was actually trading at $80. The open price on a specific date that we had a discrepancy that I had pointed out on February the 23rd, 2011, was actually trading at $80.23. So he was explaining the adjustments that they make to the historical data, and apparently these kinds of adjustments are the most accurate representation of the data that you can use for backtesting, because there can be a number of different discrepancies based on dividends and special capital distributions. So it's all explained in this email. I've taken a screenshot of it here. You can have a closer look at it. But having said that, Sam's backtest is an approximation, and my backtest is an approximation as well. So that being said, let's dig in a little bit to some more of the data. You can see here, Sam was saying he had a very profitable year last year, and it did well. And if you look at the actual yearly history, I guess this instrument started trading in November. It looks like November of 2008. you know, it would have had a losing year in 2008. But if you look at 2009, the results were quite strong. 40%, 2010, 41%, almost 42%, 2011, 58% drawdown. You can see you've had some strong years in here. You've had some flat years. 2014 is showing, you know, 0.1%. 2015 is showing a 26% drawdown or a 26% losing year. Last year was up 30%. So you have to take these kinds of wins and losses into context of, you know, the larger historical data that's available to you, because, you know, you can backtest and think, wow, this works great. It had a great year last year. And then you can run into a situation where it has a string of losses over, you know, a number of years. Or, you know, on the inverse of that, you can hit a number of really good years and not understand what the potential risks are for your system, and understanding that, hey, it could have a potentially 70% drawdown at some point in time. Okay, so that's, we're going to look at some more data because this isn't really the full picture, but it'll give us, it's one piece of the puzzle to look at, you know, a bigger picture. Okay, with that being said, let's take a look at another symbol. I think Sam's friend Rick, I believe your name was Rick. I apologize if I got your name wrong. Let's take a look at TQQ, which I believe Rick said he's trading with some fairly substantial money. So we've got TQQ here. I did have another crash, so let me just make sure I've got the settings set properly. Again, trade next bar on open, stops exit next bar on open. So this all looks good. We're going to use the current symbol, which is going to be TQQQ, and we're going to use all quotes. Let's just run a quick back test. You can see how fast the back test can be for single symbols. So if we take a look at the, we can take a look at an example of some current, this is a current trade that's underway. I guess it is initiated in January. Let's just see here. This is the most current trade. So let's look at the current trade arrow. And you can see here the trade went on here back in, that would have been January the 5th. And you can see here that the trade would have closed out actually just on February the 1st, which was yesterday. So because you did actually have a cross here, and even though it did cross back over, this meets the condition where it sells the next bar on the open. Excuse me. So that looked to be quite a profitable trade. Congratulations, Rick. I'm sure you were in it. And so if we take a look at, you know, here's the trade list, you can see, we'll just take a look at one losing trade, you know, just for balance perspective. This one would have happened 06, 09, 2016. And you can see here there was a buy signal and there was a sell signal here. Okay, so that would have been a losing trade. Now let's take a look at how this did over its entire history if you would have just bought and sold based on the crossover. So now we were using, in this case, I just want to be clear, we were using one position at a time and $100,000 per trade. Rick did indicate that he is trading larger than $5,000 per position. He said a substantial amount, but he didn't say how much. So I'm just going to use, I tend to use $100,000 as a nice even number in my back testing typically. So let's take a look at what the report looks like for this. So if you look at this, you can see right off the bat, this looks pretty good. You started with $100,000 and your ending equity is almost $300,000. So you would have made about $200,000 following these specific rules. It took 161 trades, and you can see only about 40% were profitable. You have a win rate of 40%, and about 60% were not profitable. So if you look at the actual expectancy, though, it has an expectancy of trades of about $1,221. Now that's using $100,000 position size. In terms of percentage, it's about 1%. So between your winners and your losers, you're averaging on average per trade 1%. Okay. So let's just scroll down and take a look at some figures. You've got a payoff ratio above 2, a profit factor of 1.26. That's pretty decent. You've got a maximum system drawdown of almost 46%. That's a little bit scary. So let's take a look at what this might have looked like over time. So you can see the equity curve's a little bit choppy, but it is trending to the high side. And you can see here your maximum drawdown around 45%. So let's take a look here. It looks like this instrument started trading in February of 2010. And that first year, you can see it had this strategy would have given you a 73.5% profit, which is great. 2011 was a losing year of 30%. You know, if you made 73% the year before, you can handle that. But if you look, it actually looks pretty good. Every single year is a positive year, including 2017, which is showing that it was up about 13. It's up about 13.4%. 2015 and 16 were up, but they're relatively flat. 2013 had a great year. So you know, this is what TQQ looks like. From 2010, from its inception, February 2010 to today. So you can also look at, you know, you can look at the specific trade lists and everything else. But this, you know, this is showing a very good positive expectancy. This looks really good. So let's take this analysis one step further, and let's look at this as a portfolio approach against a basket of symbols to see if we can determine whether there is a positive expectancy or not. So what I'm going to do then is I'm going to change our backtester settings here. I'm going to use a filter, and what I like to do is I like to look at premium data, which is my data provider, is really great because it gives you a lot of different ways to organize the stock data. So for example, we can use here the S&P 500, which currently is about 505 symbols. Let's look at this strategy against all of the data we have for the all of the stocks in the S&P 500. Now, there may have been some stocks that were, you know, taken out of the index, added back into the index. There may be some survivorship bias in the data, but that's something that we, at this point in time, we can't really work around too easily at this point in time. Okay, so what we're going to do is we're going to choose the S&P 500. Let's look at all the quotes we have, or if we want, let's look at, we can use dates. So let's go from January the 1st, 1999, and let's go to our most recent data, which will be one day behind because this is end of day data. Now, for the purpose of this, what we want to do, now we're not using any ranking or anything like that, but let's give it a fairly decent sample size of 20 symbols so that we'll trade 20 symbols that we get signals on at any given time using $100,000 of starting equity. So in a way, we're not really picking and choosing, but whatever signals come up first, those are the symbols that we're going to take, and using $100,000. So that's going to be like $5,000 per position. Now remember, we're not looking at any commissions in any of these calculations or anything like that. We can take a look at that after. But first we want to just establish a baseline. Oops, let's reset this. So the preset that I've set is 10 positions and 100,000. So let's see if it holds. Okay, it's giving me a bit of a problem. Let's look at 10 symbols and $100,000. That should give us, you know, pretty accurate idea. You know, not many people have more than 10 trades on at one time. So essentially what it's going to do, it's going to use $10,000 per position, and it's going to take up to 10 trades at a time whichever signals come first. Okay, now there's ways to rank and score and give priority to signals, but we haven't done anything like that because this is a very simple system. But now we're going to take a portfolio approach. This is important to test for robustness. So our settings are holding, and let's just run a quick back test. And you can see that it's actually pretty quick. I mean, it's going back quite a ways. We can look at a couple of the more recent signals. So for example, let's look at a couple of ones that were profitable. Amgen Let's take a look at that and let's see what that looked like. So you can see there's a buy point here. It looks like it's still in this trade because it's fairly recent, but there was a buy point on the January the 30th of this year. Let's look at one that's a little less recent so we can see the okay, so this is actually telling me that this is an open long, but we can see the progression of that trade. So if we look over here, we got into AMAT, A-M-A-T, on the 10th of January, and it's actually still in this trade because even though the moving average is squeezed, it didn't actually give a sell signal. So that's a trade that would have been on that would be profitable at this point in time. Let's take a look at a trade that is actually not profitable. And let's see, this was ADS. You can see it got in on the 13th of January and of this year, and it would have closed out on the 18th. So it looks like that was an over weekend type trade. Okay, so just to visually check that the signals still look good. Now let's look at the statistics because the statistics are what are really what's really important here. So I think this is a more important statistically valid analysis than our previous analyses. So if you look at this, you can see this looks pretty good. We started out with $100,000. This is trading against 500 of the biggest companies in the world, and we have a closing or an ending capital of about 500,000. So we have almost $400,000 in profits. So if you look at this, you can see the annual return. This is on a compounded basis, is 9.27%. Not bad. We've done 8,333 trades. That's a good sample size. You can see that what you can expect from a system like this, with a big sample size, it's going to be a little bit more accurate, right? So you've got 37.55% are winners, 62% are losers. So you're going to win about 40% of the time, just taking every single signal that comes around. Okay, there's a little bit of alliteration in there. It's hard to speak. So if we look at our payoff ratio is 1.19. Now, for those who don't know, the payoff ratio is the ratio of your average win divided by your average loss. Okay, your profit factor is positive. It's 1.14. That is the profit of winners, all the winners divided by the loss of all your losses. Okay. But basically what this is telling you, these are some key metrics here. If you look over here, average profit loss is your expectancy. You've got positive expectancy and positive expectancy percent. It's only 0.24%, but it's still, it's still there. So if you look at the charts now, you can see here what you might expect over time. It's a little bit choppy, but then you get into periods of very nice looking equity curves, like from, I wish they would actually delineate the exact years here, but it looks like somewhere around 2000, late 2002, 2003, all the way to 2007 or 8. And then you can see it fell off a cliff, probably during the financial crisis, and then it picked up on the recovery again. Okay, sorry, I had another crash there, which was pretty frustrating. So I still have the report open, so I'm going to take a look at finishing this analysis. So you can see here, we were talking about, you had periods of profitability and periods of non-profitability. Let's take a look at what it looked like on a year-by-year basis. So from 1999, you had some strong years. You had a down year in 2003. You had some more profitability. You had a down year in 2009, which was significant, 54%. You had 2011 was a losing year. And in between there, you had, 2016 was up 3%. The years before that were fairly strong. And 2017 so far is just, flat to slightly down. So what this tells me basically is that, when the market is trending and you have things going higher, the strategy seems to work quite well. But where you have, times of financial turmoil or, down years like in 2007, when it fell off the cliff, the markets fell off a cliff, the strategy doesn't perform so well. Now that is what you would basically expect from a trending momentum type of setup, which I would consider this. Now, if you look if we just go back to statistics, I'm not sure if I covered this or not, but let's have a look. You know, you have to be aware of what your system's weaknesses might be, and you can see here at some point over the past, since 1999 to today, it would have taken a roughly 65% drawdown, which is pretty significant. So usually when we're developing systems and looking at things like this, we look at ways of mitigating those kinds of drawdowns, either through position sizing or through using macro filters, what I call macro filters, where you can tell it not to trade in certain environments. And there's a number of ways to delineate that in your code to keep you out of, bad market environments. So, they're not perfect, but they do typically tend to help a little bit. So now let's, I'm going to have to rerun the analysis because I have to restart my computer. But what I want to do is I'm going to run the same analysis, and I'm going to put commissions into the picture and see what that looks like. Now that we're at the portfolio level, I think it makes sense to do that. So let's take a look at what that looks like, and the screens will sort of flip because I'm going to need to restart my computer and rerun that analysis. Okay, so I need to rerun the analysis, as I mentioned, which would have sounded like just now to you, although for me it was about 5 minutes ago. I had to reboot my computer again. So let's just make sure we're doing the right things here again. So we're using the S&P 500 as our baseline, 505 stocks, largest companies in the world. We are we're going to put in some commissions. We're going to put in like 1 penny per share. Okay. Now we could do per trade $9.99, but let's just go 1 penny per share. Just to make it simple, we're going to be, again, trading next bar in the open, stops exit next bar in the open, etc. for trades and stops. Okay, so now we're putting commissions into the equation. We're going to look at the same dates. This one should be till today. And we need to, let's reset this. So we're trading 10 positions, $100,000. So it's going to be $10,000 per position. So let's take a look at what this looks like again. Let's run the backtest again, and let's make sure that the equity curve looks similar to what we were just looking at. Okay, so let's take a look at the report, and so it basically looks the same. So let me just make sure, do I have per trade, commissions are a penny per trade. Okay. Let me just run that back test again just to be sure. And let's take a look at the report. Now, there's definitely something wrong here because my transaction costs are only $166. That doesn't really make sense. So let me see what might be wrong here. Oh, minimum shares is 1. Oh, it's per trade. I'm sorry, I did this incorrectly. It should be a penny per share or contract. Okay. So let's rerun this back test again, and let's take a look at what the report looks like. So you can see here with commissions. Now, commissions are important because normally you start out not testing with commissions just to see what your system looks like, but eventually you have to add commissions in because they're a reality of trading costs. So if you look here, you have an ending capital of $2,002. So you still made money here. Your annual return is about 4%, and your commission, if you look at your commissions are higher than your profit. That's, using a penny per share. That's pretty crazy. Your stats are still pretty close. You're winning almost 40% of the time. Payoff ratio is just under 2. Your maximum drawdown is 67%. That's pretty scary. And this is what your charts look like. So at one point in time, would you have been able to hold on through an over 60% drawdown? This is the $1 million question that most traders need to ask themselves because they usually think their system doesn't work or their system is broken. But if they started trading, let's say in 2011, they would claim that their trading system is the best trading system in the world. So it's very important to put context around your trading system and understand what its strengths and weaknesses might be. So if you look here, like, you've got 2000 to 2002 were losing years. The last few years were winning years. So if you look at this actually on a cyclical basis, you had 1, 2, 3, 4, 5 years of profitability, one down year. 1, 2, a down year. You had 1, 2, 3, 4, 5, and this year is just slightly down. So profitability, you can look at it as going in terms of cycles. Some system developers, what they do is if they like their system, they'll look at it after it's gone through a major drawdown, and they'll try to get in when it's at like a maximum drawdown point, expecting the tide to turn just around the corner. So that is, some system developers I've studied and read about, they do things like that. So this is the S&P 500. Now, my overall take on the analysis so far, and being objective and putting everything into perspective, is that it does show that it does have a positive expectancy and that there is validity. There is some validity to the trading approach, but you have to take that into the context of what its weaknesses are. So, for example, I'll give you a good example of how I would personally use something like this, knowing that that it does work when it works, and that it does have limitations like any other trading system. If you take an approach like seasonality, for example, I've studied some of Don Villaloo's work, and what Don Villaloo does is he looks at seasonality. He looks at the statistical performance of markets or specific instruments during certain times of the year. They usually have a fundamental reason why they move at certain times of the year. And what he does is he overlays his technical signals over top of that. So looking for an entry point. So for example, if you're expecting a buy point in January and you get a technical signal, like I would consider the 2 crossing the 5 EMA a technical signal, then that's what I would consider a buy trigger. So if you have an analysis approach, if you have a larger context of how you look at the market, and then you can overlay a trigger entry approach like the 2 and 5 EMA, I think personally, this is just my personal opinion, I think you can be successful with that approach. If you just blanket and trade every single 2 and 5 EMA crossover, I think you're going to find that the drawdowns are going to really test your resolve. So that is my opinion on the situation. Now, having said all that, let's take one additional look and see if we can look at even more symbols and see what the results would look at trading 5,000 or 6,000 symbols in the NYSE and the NASDAQ. So let's take a look at what that might look like. Okay, we're in the home stretch here, I promise. Now let's change our filters here, and what we're going to do is we are going to look at a market, and we're going to look at the NYSE. That's not the right one. The NYSE number 5 has 3,000 symbols, and we're going to look at the NASDAQ, which has another 3,000 or so. So now we're going to look at 6,330 symbols, and we're going to apply the same logic. We don't have any filters in for trading minimum shares, minimum volume, anything like that. We're just trying to ascertain if this approach has some sort of positive expectancy. And overall, using the portfolio approach, which I believe is the proper approach to take, overall, so far it is showing, based on the S&P 500, that it does. So now we've got all of those symbols there. We've got 6,330 symbols. We're going to use the same dates, 1999 to the present, and let's run a backtest on that and see what it looks like. This might take a little bit longer because it has so many symbols. So let me actually just pause the video until it's finished. Okay, so that did take a few minutes. I'm glad I paused it instead of putting in some Alex Trebek music or something in the meantime. That was my attempt at trying to be funny. So let's take a look at what this looks like. Let's run the statistics. We ran the backtest, and you can see here that the results are not as impressive, right? We've got we started with $100,000, 10 positions. We ended with 128,000. We made a profit of about 28,000 or 28%, but the annual return is only about 1.5%. Now, having said that, and taking into context what I said in my last comment, was that, we're just trying to prove if this methodology has some sort of positive expectancy. There are ways that you can actually enhance certain methods by overlaying other things to make them more profitable, or like trading the S&P 500 seems to be a better choice to trade than the entire market. But if you look at almost the entire market, or 6,300 stocks, which I would assume comprises most of the market, you can still see that it does have some sort of positive expectancy. If you look at your transaction costs, they far outweighed your profit. But it did cover your transaction costs. You can see your statistics went down a little bit. Your winners are about 34%. Your losers are about 66%. You still have that payoff ratio rather, of about 1.98. And then if we look at your drawdown increased quite a bit. Your maximum system drawdown was almost 80%. Now, I would argue that I don't really know anyone that would be able to weather that kind of a drawdown. That happened, I guess, during the financial crisis, 2007, 2008. But this is what it would have looked like over the years, right? You've got some losing years. You've got 2 losing years in a row here from 2007, 2008, 2010, 2011. Most people would have probably stopped trading when that happens. But you can see here you've got a lot of positive years. So I think we could wrap up. This sort of analysis, and I hope this approach has been helpful in looking at individual symbols versus portfolio approach, and determining if something has some kind of trading validity. So if you were to ask me what my opinion is on this based on the results that we've run, I would say the 2 and 5 EMA cross appears to have positive expectancy with and without commissions included in the analysis, using a portfolio approach. I personally wouldn't just start trading my money taking every 2 and 5 crossover, but I will most definitely look at existing trading systems where I have a method of finding good trades, and a good sort of screening process where I find trades that I'm interested in, and then potentially looking at a 2 and 5 EMA cross as a trigger entry signal in order to get an early entry into those potential trades, and building on that and looking at what kind of results I can get. So in a nutshell, I like it as a trigger entry method being overlaid on a broader contextual basis. Having said that, positive expectancy, yes, I'm sure you'll be happy to hear that, Sam and Rick, and we can investigate this further, and we can look at some additional things related to this. I came across something that was interesting when I was doing some searching, and I'm just trying to find it. I don't know if I can find it here, but Ed Sekoda's group. Ed is the famous, one of the most successful trend followers in the world. And let me see if I can just find this. I apologize. I should have had this ready. He basically, his group has a working document of implementing an EMA crossover system using Amibroker. And this is an interesting document. I will send it out to you. I lost the page that I found it at, but I could probably do another Google search. And basically, so I think I left off that last conversation at the word basically. I apologize. My system crashed again. For some reason, Amibroker and my screen recording software do not like each other at all. If I do one of these in the future, I'll have to find different screen recording software. So what I was mentioning was Ed Sekoda's group published this document. I found it through a Google search. Now, keep in mind they're trend followers, and they use much longer time frames. But if you read through the document, it talks about the buy rules, sell rules. They talk about using volatility as well in the system. and I haven't studied it in detail, but it does look interesting, and they include all of the code for the system here. So we can just copy and paste that directly into Amibroker, and we can take a look at what it looks like in the stats and everything else, similar to what I just did. But if you look at, here was their first run. They have an annual return of 5%, maximum system drawdown 47%. So, not a great system, but it definitely shows promise. And if a guy like Ed Sekoda's looking at it, it's probably worth studying a little bit more. So I will send this out when I send out a link to this video via email to all of you involved, Sam, Rick, JB, Sue, and whoever else might want a copy of it. I'll send you out a copy of that. So that being said, I hope this process overview was helpful. We can do this looking at any kind of system that we want. I thought it would be easier putting it together in a video format so that you can watch the video from end to end and see the entire process unravel. I don't know how many minutes this video is going to be. I've broken it out into 14 segments because of the intermittent crashing I was getting, but feel free to send me a smoke signal, an email, get on Skype, or we can meet in person and we can discuss this in more detail as we move this process along. So I hope that was a good objective look, good trading, and we'll talk to you all soon. Bye for now.